And before we get into the refined products and looking at what's happening in the U.S., we'd like to remind you, please like, share, subscribe. You know, your support is appreciated, and we do appreciate any comments that you have, any questions that you might want to go over, or if you have any terminology that you may want us to expand upon. You know, we're always happy to do so. So now when we look at just the averages and the aggregate demand, and we break that down based on gasoline, jet fuel, disti, and resid, you know, here you can see that on an average basis, you know, we're starting to flatline out. We're starting to get to this level. And we've been saying that we think that 13.2 million is going to be kind of that comfortable number as we start to normalize through the remainder of you know, let's just call it the winter at this point as we go through January, February, because jet fuel is going to stay depressed. Gasoline is going to kind of stay within this fixed, let's call it, you know, 8 to 8.1 million barrels a day. And then distillate is going to be that, I think that positive tailwind that's going to keep us above the 13 million level and push us closer to, you know, that 13.2. And you can see just in general, we normally see this increase in demand as we get into March. And then from March through, essentially until summer, we waffle between that 15 and 16,000 barrel a day demand, 15 to 16 million barrel a day level. And that's why we think we're just going to stay, you know, a little depressed and just hang out at this level as we go through. And you know, there's that concern against, you know, what is happening with COVID, where are the vaccines, where herd immunity, all of these different components are gonna keep people essentially cautious and just limit a certain amount of travel as we go through Q1. Now, when we turn to distillate, distillate had it was still a build, but it was a surprise to the a bullish surprise in the sense of what was expected and what the market delivered. So here the build was about 460,000 barrels. The draws were driven by Pad 1, Pad 5. Those are things that are going to adjust a little bit. Pad 1, we had a little bit of cold. That's adjusting a bit. You know, things have warmed up a tiny bit, but again, it's supposed to get colder again. And the reason why we talk about that is just heating oil is going to be a big moving piece, especially for Pad 1, given the East Coast, Northeast. Imports, you know, we continue to see imports. We finally flipped where we now are back to having more gasoline versus distillate imports. So this will start to come off, but again, it'll still be elevated. It'll just be at a lower rate, and it's all because Germany and Europe in general has been trying to push some of this distillate into the market just to try to manage their systems and manage their storage, which is put more distillate into the market. It has gone, and that's where we would keep talking about it, and we'll go through it again in part three, how it's taking some export capacity that typically Pad 3 goes into. And when we look at just where supply is, you can see that on a storage level, we're still trending up, but again, we've kind of flatlined at this point. And if you just look at the average, we typically decline from this point up until about April. And the question is, are we going to see that type of decline, or are we going to just go sideways at this point? Now, when we look at some of the disconnect at this juncture, we think that there's going to start to be draws. The draws will start to come through, but it'll be at a very muted pace, and we're not going to see the movement that we really need to get to essentially that more average level. And when we look at just the production as from a refining level, right now the production is down a little bit for distillate. It was up a decent amount for gasoline, as there's this pivot of moving away from disti and trying to start to create some of the summer blends, just because there's a lot of hope that summer is a little different. So again, that pivot from the distillate focus into the gasoline focus will help draw down some of these stocks. But again, it's not going to be at a pace that we really need to see to whittle this down at the levels. And the reason why is, and as we've been talking about, when we look at demand is going to continue to pace the normal seasonal, let's call it the 5-year average, but it's just going to be not just below the 5-year average. We're not really going to get to where we're really outpacing it and making up some of this demand. just because there's still less activity happening on an industrial level, manufacturing level. When we look at PMI, the flash PMI today, it was very strong, but it was very strong because there were a lot of issues that remain within the supply chain, and the supply chain is still struggling to get some of this product through to clear some of the issues at the ports, which again is creating some of this headwind. So even though it looks better, there's still some mitigating facts when we start talking about how much trucking is out there and how much rail is really out there. So when we look at trucking, as we said last week, and really 2 weeks ago, after we sat at that 130 plus for 2 weeks, our view was that we were initially at a 95 to 105 comfort zone. And as we came into January, we shifted that up. We said, look, we're too low. It's going to be 105 to 115. And here we are. It fell back within this 111. And we think that at this point, it's going to just go sideways and we're going to waffle back and forth really between this higher normal. And it's just, again, coming to just the need for supply chain, moving some of this stuff through the system. And inventories are starting to normalize a bit, but we're still getting commentary from retail, wholesale, small, big, pretty much any type of company is still thinks that is looking at and showing that they need more inventory, which is going to keep these truckers moving across. And as we look at truck availability, truck availability has come back a little bit. You have load availability dipping a touch, but again, it's just going to kind of factor in with where this is. And as more trucks become available, we'll start to see some of those movements. The benefit as well is we've seen some normalization in trucking rates, where they've started to come down. Refrigerated trucks remain robust, but again, coming further down. That will start to see some support and shift a little bit higher. Just when we look at some of the commentary coming out of, or just recently coming out from food stores and grocery stores, saying that with a increase in COVID and an increase in some restrictions for restaurants, they've seen another uptick in demand, which again, they're going to have to refill their storage as well, their inventory, and that's going to help support some of the refrigerated trucks. But again, this remains that bright spot, and this is really the biggest driver behind that diesel demand that we see in the U.S. Now, rail continues to be strong coming out of the gate. On total carloads, it's down 2% versus 2020. But when we look at what is really driving this, again, grains is going to continue to outpace 2020. Based on where we're seeing it, the 42.6% versus last year, it's going to continue to beat by 20 to 40% over the next couple of weeks. We're starting to see some commodity prices come down now that we're starting to see some of this normalization. The dollar's essentially flattish, but again, it doesn't change the fact that there is a global demand for U.S. grains. There was another locust swarm that is hitting Kenya. There's been another outbreak of avian flu in not only just India, but also France. Again, these are things that are just going to continue to support, which again is also going to move farm products across the board. Lord, when we're looking at ferts, seed, all types of things are going to continue to move. Non-metallic materials, petroleum products, motor vehicle products, those are things that are going to continue to struggle. Intermodal is the one that had another big uptick. And just based on where we're seeing the bottlenecks at the ports, a lot of that is going to have to clear. And just because we've seen trucking demand go up, prices for trucks go up, that's going to put more stuff on rail, especially as we get some normalization at the retail side or really at the wholesaler inventory side. Once they start to get a bit more comfortable with some of their timing, because rail takes a little bit longer. So you need to have stuff in storage or stuff in inventory and wait for the big slug to come through. Because when you think of a rail, and you think about sitting there waiting for these cars to go by, there's 100 to 140 carloads. What is a truck carrying? One, maybe two. So again, that's why once you start to see some of this normalization and people getting comfortable, then they'll go and they'll start buying in bigger bulk and waiting for the bulk of the inventory to come through, which is just going to continue to support intermodal traffic and total traffic, especially when we compare to 2020. And again, it's just weak comps. 2020 was a soft year, especially at the beginning of it. So this is going to provide some strong year over year. Now, this is a new data point that we found, and I really like it. And it really, I think, really shows where the problems are in terms of looking at Los Angeles. We talked a bit about this in the Econ show, and we said that we were going to start to incorporate this more. You can see the acceleration through January into February in terms of the import volumes. But just because the import volumes are coming, it doesn't mean they're going to be able to get into port, because there are still massive bottlenecks. There's still a ton of ships that remain at anchor, waiting for a slip to come in, waiting for that offload, onload. So even though we know that there's going to be a big surge coming at the end of January into February, they're going to be sitting there in the penalty box waiting to get to port and to offload. But it also supports trucking. It supports rail. It's going to keep a steady movement of goods coming into the U.S. And again, it's going to have to use our roads, our rail, which is going to help support and put a bid beneath that diesel for the most part. But then when we look at gasoline had a surprise draw of about 260,000 barrels. And I say surprise, I mean for the market. We've been talking about how this past week we were going to get a makeup number, and it's just because when we look at Gas Buddy, when we look at Descartes, when we look at some of the numbers out there, they were really outpacing where the EIA was. So it all comes down to timing, because again, Descartes is looking at people driving with their phones sitting in the car, and then Gas Buddy is looking at the pump. So it's still depressed. So you're still not burning as much fuel, so you don't have to go to the pump as much. So even though you're seeing some of the data, it's just going to be a matter of, well, okay, you're filling up a bit more, which is where Gas Buddy's going to pick it up at the pump. So you're going to have to draw down the gas station. The gas station is then going to have to go to the rack, and then the rack is going to have to go to storage. So again, it's just that supply chain component, but we are starting to see a little bit of a stabilization at this 8 to 8.1 million barrel a day demand on the gasoline side. Now, imports are going to continue to be fairly stable. When we look at the year over year, the 5-year average, even though we had an increase of 122,000 barrels a day, we're still right in line with the year over year. And based on the data that we're seeing right now coming into the U.S., we're not going to see too much change on a year over year level. We're just going to be pretty much right in line, which will support some of the demand in PADD 1 specifically. Now, when we look at total gasoline, you can see that we're now back within the bottom of that cloud, which is obviously a positive in terms of getting to some of that normalization. But this is that makeup number that we were talking about where we had that big spike up. Now, we're not saying that we're going to drop way back down in terms of where this is. We just think that we're going to hang just below the bottom of that cloud going back to 2006. Just as we start to see some of, we get this makeup volume going into to the racks, to the gas stations, and now we're going to start to see some of this, essentially bottom out a bit, because we do continue to see some pressure when we're looking at TomTom data and some of the other high frequency data points, as we try to review and look at where are we seeing demand, where are we seeing some slowdowns. But again, this is a net positive when we're considering where we sit on a go forward level and, getting to some sort of normalization. But again, it's just going to be back at these lows. So when we talk about that stumble, and now obviously we're more on the cautious side, but our view was that we were going to see some of this activity on a global level, and this is looking at developed markets. We thought we were going to see this drop, post holiday or during the holiday. So we got a little bit of a rally into the let's call it the second week of December, and then we had a big drop off. And then as we go into January is, again, a little bit slower, but we thought that by the end of January, we were going to start to get back to where we were, or at least approach where we were the first to second week of December. And you can see that is just not the case. We have that is we were hopeful that was going to happen, but when we look at Europe specifically, we see these big turndowns. Really being led by Italy, as we know that they have their own issues in terms of the problems on the government level, but also some sticky cases that they can't really get past. France is threatening a new round of lockdowns as they have cases that are starting to increase. Germany can't get comfortable. They keep extending their lockdowns. That's now out till April. So we're starting to see some of this rollover. And then when we look at December into January, the PMIs, or the Product Manager Index, coming out of Europe actually surprised to the downside. And we're now back into contractionary mode, which isn't surprising when you look at the information, when you look at the slowdowns, when we look at the pressure that's been coming in. So it's not that it's surprising, it's starting to now feed through the economic data, which we've been really kind of guiding to, which is going to put more product into the market, less demand within Europe. And the U.S. isn't much different. As you can see, we're kind of within this congestion, hanging around this 64, 63% level. And we'll go through that at a bit more detail and pull out the U.S. information. But again, even Japan's seen that rollover as well. Now there's commentary. Will they have the Olympics? Will they not have the Olympics? We don't think they'll have the Olympics, or at least I don't think they will. But again, they're seeing their own issues, which continue to reverberate through the system, which we talked about in segment 5 of the Econ Show. Now, when we look at the U.S. and just the 7-day moving average, we're pretty much back to where we were. For workplace, retail and recreation remains depressed, which is going to continue to remain low. Grocery and pharmacy stores, the one that we think is going to start to turn up just based on some of the data that's come out on the high frequency side. But again, it's still gonna what we think is underperform a bit, just given people are doing a little bit less, with some of the uncertainties in the market. Again, that's going to keep people on the sidelines. As you look at the transit station, people are just taking the opportunity and either doing blended schedules or just driving a bit more, because you can see they're going to the workplace, but they're avoiding the transit, which is going to be a bigger component. Some of the bigger headwinds that's just going to cause some problems in the market is this China piece. So we see Europe rolling, we see Asia rolling, and Asia's rolling because of not only just China. India was down, Japan, Malaysia, Indonesia, South Korea all had this rollover. And you can see North America also had this little pause, and it's coming down a bit. But again, we think that we're going to hang out right at this level, again, giving us that confidence about where we sit in terms of this demand number. China is the one that's going to pressure, because we're going into the Lunar New Year, kicking off February 11th. And right now they're guiding to a decline of about 30 to 40% of movements from 2019, and the requirements needed to travel. It's a negative nucleic test. All of these things, they're going to be paid out of pocket, and just based on timing of getting the appointments, getting the information. Again, this is a means of trying to just limit movements, which we're already starting to see, especially because the cases continue to rise, and they're rising more on the rural side and starting to shift a bit more into Beijing and some other populated areas, which is why China's taking this, obviously seriously, and they're locking things down. So this movement, we think, is going to continue to trend lower in China, putting more product in the market, less oil demand, coming into China, which we'll touch on or talk about in more detail in the third segment. That's going to put, again, that pressure in the global market in general. And when we look at COVID-19 rush hour, this is how we closed out the year. You can see the AM PM rush hour. And this is what we've been saying as we go through September into December. We think we found this kind of comfort level. And when we talk about rush hour and just congestion, this is where the blended schedule comes in, because we do have people that have gone back to the office for the most part, but everybody who's moved from the urban to the suburban, they bought a car. You can look at the data and see that they've bought cars. But we're still not seeing them go into the office, or at least we're not seeing them go as much into the office. We're seeing more purchases online, Fresh Direct, Dash Cart, whatever you want to call it, or whatever program you have near you, where people are still purchasing online, not going to the store, avoiding the stores in general. And it's just, this is buying behavior. The people the most recent people, or the last wave of people moving from urban to suburban, much younger children, and they're already used to purchasing online. This is not a learned action. It's something that they've been brought up with, and the comfort is really there. And just thinking about people of maybe your older aunts, uncles, grandparents, how many of them don't use credit cards online or are concerned about having their identity stolen? Most people on the millennial side don't see that. And when you think of millennials, or the oldest ones now turning 40, again, this is where that consumer behavior is really going to start to pick up, and I think start to eat into not only just the comfort of that blended schedule, which is appearing here, but also just the consumer and what is bricks and mortar versus e-commerce versus curbside. And I think that's going to be an interesting dynamic as we go through the recovery process and get into Q3 and Q4. Now, just rounding it out, so according to Pay with Gas Buddy data, gasoline demand so far this week is down about 0.5% versus last week. And last week, which the EIA picked up, was up 1.1% week over week. So again, we saw this move coming. That this was the second week in a row that Gas Buddy had reported an increase, even though last week EIA showed a decline, which is why we were talking about that pickup. It's the strongest week since December 19th. So that, again, getting a little bit closer back to where we think we're going to kind of balance out, which is that second week of December is going to kind of be that baseline where we think things are going to be. U.S. gasoline demand rose to about 1% based on Descartes data, and they're estimating at about 8.4 million barrels a day. That's a little high. Again, just when we start to layer in how much people are driving, how many phones may be in the car, not to say that you can't scrape that out, but there's going to be some of this balance, which puts us closer to 8.1 level, especially as we get a little bit of a slowdown now that we're out of December. Again, that balancing act in general. So, but they also had reported an increase, which is why we knew that there was going to be some sort of pop, and it came pretty much right in line with where we were expecting. Apple data is showing kind of what we think Descartes is going to start showing, where the U.S. is sitting right at the baseline of about that 0%, really not growing or doing much versus the starting point. And then obviously the UK, Germany, Italy, as we highlighted before, is settling out at these very low numbers. And we're just not getting those spikes to the upside. Because if you look, there's typically that normal, ebb and flow. Instead, we're getting these big drops to the downside, and then we're coming back up into this 25 to 30% down below normal. And there's just not much to say that we're going to see a huge difference. This is some positive information now. When we think about the U.S., daily cases have a nice drop. Current hospitalizations, again, daily cases go first, hospitalizations go second, deaths go last in terms of the severity of the drops lower. So this is still positive moves, and this is coming just as we still have a huge amount of tests being done. So again, this is some of that positive information in terms of these rollovers. The question will remain: are we going to get a March surge? And that's one of the concerns that we have at this point in time, is that we had the holiday push. So you can see we had the holiday surge. Then we start to normalize, people pull back, they're not seeing families, they're quarantining, and then we should see a decline into February. Now, if you think about when more people get sick, it's usually during seasonal changes. So as people get more active, do more things in March, are we going to get that March pop that we normally see in colds, in terms of flu? These are the types of things that we have to look at when we're considering how is this going to look, not as we exit Q1 and head into Q2, especially because we had more announcements on delays. AstraZeneca has cut their expectations into Europe in terms of the vaccines they can deliver. We know Pfizer cut as well. Again, these are things that are going to slow down that inherent movement and comfort that people have. And when we look at just general net change in cases, the U.S. is starting to slow, but still remaining at this kind of stability of November, let's call it mid-November onward. Worldwide cases continue to be flat. India has had a little bit of an increase, but it not too concerning yet. As you can see that they're just essentially flattening out at these levels, which is why India is maintaining some of their restrictions. European Union is the one that, again, is in this sticky realm where they can't get down below, which is why Europe in general is maintaining some of their lockdowns, as we talked about in the Economy Show segment 1. That's going to be an issue for demand. South Korea is maintaining their stringency index, even though they're seeing their cases start to normalize. But Japan is the one that still has these increases, which is why Japan continues to see a decline in terms of just oil demand, activity, walking, purchasing, because of these cases and these lockdowns that are being created. Now, when we look at vaccination, here you can see the vaccinations. This is looking at a log scale, just to give you an idea of kind of where people are started. India is just kicking off now that we're seeing them start to increase. This is how many vaccine doses administered per 100 people. The U.S. is starting to flatline, which is the concern at this point, because we really need to see some of this acceleration. Something along the lines of Israel. Israel had. Again, it's still in data. It's still trying to work through, but Israel's saying that they're not, the efficacy that Pfizer promised is not what they're seeing in the data. Now, obviously, Pfizer said 95%, so there's going to be 5% that isn't working. They're seeing something a little bit greater. And South Africa is seeing a fairly large spike in cases and actually deaths. And the concern is the strain they're seeing is essentially escaping immunity for people that were immune or had it before. They're getting reinfected. So we have to really watch how these variants are going, because this is a coronavirus. It naturally evolves and morphs and changes. So these are things that we have to keep looking at. How effective are the vaccines? Are they going to maintain their effectiveness? And here you can see France is starting to pick up, which is a positive. Again, these are all positives. It's just the pace at which they continue to roll out remains a problem. As we've been saying from day one, we have a brand new vaccine, never created before, ramping up creation in a logistical nightmare that's created outside of the fact that these are difficult to move based on the way they have to be moved in terms of the cold, in terms of the just climate that they need. And again, these are things that are going to be a headwind. Now, when we look at jet fuel, again, this is the drop that we saw. So we had a build of 2.16 million barrels across the board. We just think that we followed the normal trend down. You can see it's obviously at a much greater pace. And this is just going to hold within this, let's call it, 950 to 1.05 million barrels a day of demand is going to be kind of that comfort level that we have as we go into the remainder of the year. And I said that correctly, the remainder of the year. This isn't something where we think that we're going to get this huge surge as things come back. Again, this is something where jet fuel is going to be a big problem, at least through Q2, and it's going to be, do people travel more in the summer? Do they do less on the plane and drive more in the car as things start to open up? This is going to be that conundrum that we're going to have to really start to see develop, because a lot of the bull cases really, driving is going to normalize way more in the summer as people look to do more and utilize the cars that they purchased at the outset of COVID in general. But when we look at just activity, 775 fewer departures on average each day, week on week, you can see the biggest drivers are Asia. China's imposed a new rule requiring all Lunar New Year holiday travelers to present a negative COVID-19 test before departure. Again, this is going to impact just activity. Flight activity and jet fuel consumption will suffer the week-long holiday in mid-Feb. Europe-based airline restrictions continue, so we still see Europe weak. We still see Asia weak. Russia, again, part of Europe, weakness. The U.S. is really not doing too much with small declines. And as we keep saying, February is going to be a very tough month. So we're going to see some of this move lower in just general demand. Again, that's showing up in the data, lower highs, essentially stable lows. And we stay within this 550 to 850 range, not much to say one way or the other. It's pretty consistent. Same with OpenTable. We've been saying that this 63 to 60, 60 to 63 is going to kind of be that average as we go through winter and as the restrictions remain pretty robust throughout Europe, which we're seeing here when we look at global, when we look at Australia. Australia has had some goose eggs, which has been great in terms of getting people back into the economy. But when we look at Canada, Germany, Ireland, UK, these restrictions are 99 to 100%, and Germany is extending that through April. Ireland has had their spike; they're extending that through at least Feb. UK is something similar. US is averaging between this, let's call it 55, 50 to 55 on the weekends, 60 to 65 on the weekdays. There's not much to say that that's going to change, just given where COVID sits, where the problems remain. So again, there's some positives, a little bit more positives coming in, but still an overarching problem, especially when we start to roll in how does the rest of the world look, especially when we turn to China and how some of those flows are going to adjust over the coming few weeks.